We have to be patient in private markets. That's the nature of things, to actually make sure that when you actually book an asset, it does deliver what you have promised to investors, which is generating alpha versus public markets.
Would you say it's currently a good environment for entering private markets, or should investors maybe, when they're not invested yet, better wait?
I think it depends on what asset class. There are some asset classes which we really like. We like this energy infrastructure topic. We also do like private equity at this point in time. We do not believe, with regard to return expectations, that you will see 20+%. Yeah, because very simply, we will not see that multiple expansion possible. Yeah, with yields which are much higher. So, in that sense, return expectations will come down, probably more in the 15s area, but still, small mid caps are relatively cheap. So private equity companies can buy in cheap. So and can manage these firms actually quite well. So on that front, even with higher financing costs, the equity part will be higher. Therefore, the risk in these transactions will be lower. We're actually quite positive on private equity, positive on energy infrastructure at this point in time. And also private debt is quite appealing for us. So on certain topics, we're actually quite constructive, and we recommend being exposed to private market assets. Yeah.
So yes, we are positive about private markets. We covered infrastructure a lot. So there are, especially when you are an equity investor, a lot of opportunities in the market. Forestry is something we are looking really deeply into it. And maybe to an asset class we haven't covered yet, real estate. So as an equity investor.
China.
Well, China is not so of interest in our portfolio, but well, maybe in the second round we can cover that. But there are opportunities in the market if you are an equity investor. So maybe for the second round, interesting topic.
Yeah, we are always bullish for private markets. So we are in this business for roughly 25 years. And I recently made a calculation. If you would have invested, for example, always 100K in every offering and would have recycled the distributions, etc., so the development of that portfolio would have been extremely nice and very, very stable. And well, valuation at the moment is certainly a topic. So therefore, we are seeking access to managers who have a huge capability in operational improvement. So even if the multiples come down, if the EBITDA is doubled or tripled, then that is a very good protection. So we want to see from every manager, do you have a 100-day plan for your companies? Do you have experience to grow companies, to cut costs, to do digitalization, internationalization, etc., to make sure that even in a more difficult environment, those companies have the potential to develop nicely and to produce decent returns for our clients.
Yeah, we would not engage in timing the market, and even less for private markets. So what I'm trying to say is we want to have a stable allocation, a significant allocation. That's what we want to see in our clients' portfolios. And then I heard several times here in this roundtable, I like this idea of mature portfolios. So I like diversified access to private markets. And even if I'm not bullish or totally bearish, I think every year we need to build this portfolio to actually get, let's say, institutional type setup, right? Where it's a lot about strategic asset allocation and not so much by definition almost about tactical asset allocation.
Yeah, I think you should stick to your core allocation, but I think as an investor, you don't have to hurry up. So it's not that you have to do a lot of investments now. I think you can be opportunistic. And I think there will be quite a few opportunities. I mean, looking at what the market's currently showing, You mentioned the real estate market. There has been the one or the other interesting deal, so to say. And I think there will be more interesting opportunities going forward. While obviously infrastructure is something we try to acquire faster, but difficult due to not enough projects. But I would say in general, don't hurry, be selective, be opportunistic. You have time.
You're probably a bit biased if investors should add more exposure. So maybe a question to you.
Totally not.
Not talking their own book.
The question maybe for you.
No, I think
why
the
should
timing.
investors-
I think the timing is quite interesting. I think generally speaking, if you're going to generate alpha versus public markets, to actually put everything in one go it just doesn't feel right, and that's not actually the reality of private markets. You actually have a bit of lumpiness in most of the segments, so it's not true of all. So those generalizations are always a bit dangerous when we talk about private markets. But patience. But patience is, we have to be patient in private markets. That's the nature of things, to actually make sure that when you actually book an asset, it does deliver what you have promised to investors, which is generating alpha versus public markets.